PepsiCo is trading near a 52-week low, and the dividend yield has climbed to about 4.4%. For a company that has raised its payout for more than 50 straight years, that almost never happens. Here's what the market sees, and what it might be missing. Start with the top line. Revenue grew from $79.5 billion in 2021 to $93.9 billion in 2025, up about 18% over 4 years. But look closer. Almost all of that growth came in the pricing surge of 2021 and 2022. Since 2023, revenue has crawled from $91.5 billion to $93.9 billion. The growth engine slowed, and the stock derated with it. The second quarter of 2026, reported July 9th, tells you why the debate is live. Net revenue rose 6.4% to $24.2 billion, beating expectations. Organic growth was just 2.4%. Currency and acquisitions did more than half the work. Reported earnings per share more than doubled to $2.18, but that's against a prior year crushed by a $1.9 billion impairment on Rockstar and B and Cheery. The cleaner number is core earnings per share, $2.20, up 4%, a penny shy of the street. Here's the number nobody talks about. PepsiCo's international business has now delivered at least mid-single-digit organic growth for 21 consecutive quarters. It grew 7% this quarter, international operating margin expanded about a full point, and management says the business will cross $40 billion in revenue this year. Look at the quarter by segment. Latin America foods up 15%, Asia Pacific foods up 12%, international beverages up 11%, Europe, Middle East, and Africa up 10%. Then North America, beverages up 7%, mostly acquisitions, and the foods business, Frito-Lay, down 2%. Every engine is running except the biggest, highest margin one. That's the two-speed company in one picture. North America organic revenue actually declined 0.5% this quarter. Management blames high gas prices choking convenience store traffic, plus price investments that haven't fully paid back yet. Meanwhile, international is now 2/3 of total beverage volume and over half of food volume. The question for investors is simple. Is North America a fixable problem or a mature business in structural decline? Now, the number that defines the stock today. In fiscal 2025, PepsiCo paid $7.6 billion in dividends, 99.6% of its $7.7 billion of free cash flow. The entire cash engine is committed to the payout. That's why the 4.4% yield is real, and why the market gives management so little room for error. And the valuation gap is historic. PepsiCo trades at about 15.6 times forward earnings. Coca-Cola trades at over 25 times. Mondelez at over 18. For years, these two giants traded side by side. Today, the market pays a 10-turn premium for Coke's momentum and gives Pepsi almost no credit at all. So, what's it worth as a normal business? We ran a discounted cash flow under 3 scenarios. Base case, about $9.5 billion of free cash flow, growing 4.5% a year, discounted at 6.75%, roughly $144 per share. The bull case, where the turnaround works, lands near 187. The bear case, where North America keeps shrinking, around 87. At today's price, near $136, the market is pricing below the base case, effectively zero credit for the turnaround. To be clear, these are implied values under stated assumptions, not price targets, and not investment advice. The catalyst is Elliott Management. The activist disclosed a roughly $4 billion stake last September, arguing the upside was more than 50%. In December, PepsiCo struck a collaborative agreement, cut product offerings by about 20%, simplify ingredient lists, invest in affordability, and drive aggressive cost reduction. Management already booked record productivity savings in the first half and says more layers are coming. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. Here's the bottom line. PepsiCo is a two-speed company priced like a one-speed company. You're paid about 4.4% to wait, funded by real cash flow, while Elliott and management try to restart North America. Watch three things: whether Frito-Lay volumes hold as the price investments get optimized, whether guidance actually lands at the low end, and whether the international margin story continues. This is a framework, not a recommendation. Do your own homework. And if this analysis helped, subscribe for more filings-driven deep dives.